Our Treasury Secretary a few weeks ago said that we are financially insolvent, meaning we cannot pay our debt. That's why the bond market matters so much. Stocks can still rally, AI can still explode higher, but if the bond market loses confidence, everything reprices. That's when you can see a pullback, 5%, 10% in the market, or an overall recession. I know people don't really like looking at bonds, but of course, this affects everything, right? It affects our credit, it affects our borrowing rates, it affects ultimately our prices, because if our producers have to borrow money at higher rates, then they then have to lay that charge on us. And the bond market is starting to look very dangerous here. But if there's something that can stunt our growth right now in the stock market, our momentum, it's that yields are surging globally. And if we look at the US 10-year hovering around 4.5%, the UK 10-year above 5%, Germany above 3%, France near 4%, Japan is at near multi-decade highs. So of course you have to look at the trade-off here. If the S&P 500 is offering you 10% every year and bond yields start creeping up and they're considered risk-free because damn near no government is going to default on their bonds. Of course, the US is the only major country that hasn't. You start to ask yourself, okay, why would I put my money in equities and take on the risk if I can now get 6 or 7% on my money? Now, right now, it only yields 4.5%. But if bond yields keep rising, there is a trade-off to be settled. And many people, global market participants, are going to assess this alternative. And these governments already owe enormous amounts of money. The United States alone, we're over $39 trillion in debt, and interest payments alone are approaching $1 trillion annually. Now, it's hard to fathom those numbers because we're not spending that on defense. We're not spending that on healthcare. We're spending that on interest. And here's the dangerous part. As yields rise, governments must issue debt at higher interest rates, meaning deficits worsen faster and markets are beginning to question. So now investors demand higher yields to compensate for inflation, geopolitical risk, and our overall fiscal instability.